Hi, I'm Michael Yorba with CEO Money. Thanks for joining us. I'm here with Michael Markowski, a contributing editor to WFN1. Michael, thanks for joining us first. You correctly predicted the crash of the Lehman debacle back in 2008. Tell us more about that.
Well, that's one of the first really crashes that I predicted, and this is how it worked. In 2001, after Enron crashed and burned, that horrible death with 28 analysts recommending its stock in December of 2001, I did an autopsy on Enron, and I discovered the anomaly in its financial statements. And I took that anomaly and I went out and back tested it and found that there were 100 other companies prior to Enron in the previous 5 years that died of the exact same cause of death. So I took that and created an algorithm out of it and created a individual company crash detection system called the EPS syndrome. And then what happened is I found that Lehman Brothers, Merrill Lynch, Bear Stearns, Goldman Sachs, and Morgan Stanley were all afflicted with the same thing years later. In 2007, wrote an article that everybody to get out of these stocks, that the day of reckoning was coming. And that's really the first time I predicted a crash, because I predicted that algorithm. And of course, the three of them didn't make it, and the other two went down by an 80–90% before they were rescued by Warren Buffett and Mitsubishi Finance. So that's Morgan Stanley and Goldman Sachs. So that's what happened with that one. So that's the first crash that I had used my expertise in, that one.
All right. Well, Michael, the demise of Lehman and the crash of 2008. In 2016, you also created a mini crash warning system. Tell us about that.
Well, what happened is when the Bank of Japan announced that they were instituting a negative interest rate policy, I knew it's really dangerous for the markets. So I went in, did another investigation, and did about a month's of research on the previous crashes to see if I could find something that would have been an anomaly, or something that would have caused that crash, or would have alerted me that crash was happening, and I found that. And then I created an algorithm out of that, and that algorithm, I used it throughout 2016 when the negative interest rates were growing and were really expanding, and the crash was very accurate and predicted the Brexit crash. That was the one crash that it predicted. It was the most significant crash, but it's a crash detection warning system. And it can be used by investors to hedge their accounts. It can be used by futures traders to trade the market on the upswings and downswings. And I put it on the back burner last year because there was no volatility in the markets, but I'm going to dust it off pretty soon and put it back in action. By the end of the year, I'll put it back in action for people to be able to use it.
So you see reason to bring it out now. There's writing on the wall about what's going to happen next.
Well, the S&P, to give you an example, I think somebody had said the other day on Bloomberg, the S&P was down more than 1% 3 times during 2016, and for the month of February, it was up or down 1% 12 times. So the volatility has clearly picked up. And in fact, the markets were down they've been down in March and February. But yeah, definitely the volatility is going to start picking up. When that volatility picks up to a certain point, and I'm looking for currency volatility also. I'm looking for the currencies to get more volatile because they interact with each other, the markets and the currencies.
Are you seeing telltale signals right now about what's happening with the currencies that are giving you a
Well,
heads
I
up?
see the currencies I see that they're getting more volatile, absolutely. Okay. But when they really take off and get volatile, then I'll know that that's the time to deploy this. And there's a reason for that. I actually have a video about it. And it's because of the yen becomes everything trades against something in the world. Right. You're a trader.
Okay. Yes, I'm trading.
So currencies trade in pairs. So, when you know the market's going to crash and you're a foreign investor, there's investors in 200 countries in the world. Right. What currency do you want to, if you're going to short the dollar, because if the market's going to crash, the dollar's going down, what's the best currency you want to be long? And that's what all currency trading is. You're shorting it, you're going long one currency and short the other.
Well, it tends to be anybody's guess because whatever country you're coming from, you tend to want to stay with your sovereign.
No, actually it's not. It's the yen is what everybody does it with, because the yen's the most conservative fiscal country in the world. So so Japan is the most conservative fiscally. in the world, and they are very, very conservative socially as well. So everybody moves to the yen when these crashes start really getting full-fledged.
And you're seeing movement
and
in the yen
everything
now?
goes down. The euro goes down. All the other currencies go down. The yen holds, is what happens. So
Okay.
yeah, well, I'll be tracking that with that NERP crash indicator, but I'm not using it right now. It's not enough currency volatility right now.
All right. Now, you came up with a school of thought that tariffs have to do a lot with this. And something happened in 1929 or 28, and then finally in 30 it enacted a law. The
Well,
seal
what
tariff.
happened is, what happened is, my article is now just published today on WFN1 about the Smoot-Hawley tariff that was enacted in 1930 caused the crash of 1929. And this is, I think, my
Explain
career,
that a little bit.
I know. My career has been about sleuthing, Michael.
Yeah.
I'm a sleuth, okay? I go in, I look for crazy things that happen in the market, and then I investigate them. And I was doing I did an article, and it's posted on the site as well, about the Smoot-Hawley tariff. And doing that article, I saw something in it. I said, hey, I better dig some little deeper in that. So I went in and started digging. And I was shocked that the Smoot-Hawley tariff caused the crash of 1929, even though the tariff was not enacted until June of 1930.
How did that happen?
Well, what happened is Herbert Hoover ran when he ran for president, on his campaign pledge was to enact tariffs for the farmers. So as soon as he got elected, the House of Representatives announced that they were going to start having this was in December of 1928, that they were going to start having getting testimony about the tariffs that they were going to enact. When that happened, if you look at the chart here, I've got right here, the market crashed, okay, on that news. And then what happened is the market went along, and then when in March of the next year, in 1929, one of the Republicans, one of the congressmen or one of the senators came out and said, hey, we think that the tariffs are going to be brought, where it's going to be hard to narrow the scope of these tariffs. In other words, everybody was hoping, the market was hoping it was only going to be agricultural, but it could have been more, okay? So then what happened is the House came out, and if you look at this chart here, the House came out in May of 28, and it passed its version of a broad tariff and taking all goods and services as well as agriculture. And the market, you can see the market crashed again here by this chart. So that's what happened that led up to the crash. Those are the three pre-crash things that happened. But there was a thing there where the market was definitely, investors were really spooked about these tariffs. There's no doubt about it. Every time that any announcement was made, that's what happened. And then of course you had the crash of October 29.
Well, when they finally passed the bill, that's when the long trend ensued. So you're saying that
what
was
I'm saying to you. So here's what happened next. And what happened next is the fourth crash happened in 1929. Now, in October of 1929. So the market peaked in September of 1929, early September the 3rd. The reason there was there was news out there that the Republicans were going to work on their version of the bill, start the work version. So that spooked the market, but it didn't cause a crash. But what happened is on October the 23rd, the Senate and the Finance Committee and the Republicans and the Democrats that were trying to get this thing done, then the market believed they were going to pass a narrow version of the tariff. Okay, a narrow, just agriculture.
Right.
Well, what happened is at the last moment on October the 23rd, which is the day before Black Thursday, in the last hour of trading, the Senate announced that not only did they have the votes to pass the tariff, but the Democrats who were fighting the Republicans on the side for free trade switched, and they flipped, and now all of a sudden you had a solid majority of the Senate, and they wanted to go the full tariffs instead of the narrow tariffs. So the market crashed big time in the last hour on October the 23rd, and then the next day was Black Thursday. But that's nowhere in the history books. That's what caused Black Thursday, was what happened with the Senate switching its position there.
So are you saying that these tariffs that happen, that same kind of pattern is reoccurring right now in our economic?
Well, I'm saying to you, if you look, let's do a little further investigation here. So here's what happens. So the market crashes, and the market crashes, and finally the Senate was going to vote, was going to hold its vote. The Senate had the votes. They announced they had the votes on October 23rd. They said they were going to vote it. They were going to do a special session in early December. They canceled the special session, and then the market rallied from there until April of the next year, because everybody thought, well, maybe they're not going to pass this crazy tariff. Okay, that's what the market thought, and then the market made a great comeback, and went back to its trend line in April of 1930. April of 1930. Well, the next thing that happens is 1,028 economists all signed petitions asking Herbert Hoover in early May to basically veto the tariff. Now, if you see here on there's another example. The market crashes again. Here's another look at this chart here. Okay, then what happens? Hoover. There was no word from Washington whether he was going to veto it or not. Market continues to move along, not sure what was, just like it is going on today, with all this stuff. So then what happens is Congress and everybody gets together, passes the tariff in June of 1930. And the president announces, as soon as the president announces that he's not going to veto it, the market, you can look at the chart here, just went right through all of its old support. I mean, you're a trader, you see this stuff. Yeah. It just went right through its all support. It went right through support, and then down to a 89% low from the high in the middle of 1932.
What do you think is going to happen now?
Well, I think that now, I think the key is people would argue that, well, that was 100 years ago, okay? But
it's different this time.
Yeah, everybody argues this is different this time. But you look at this chart. Look at Bush enacted a steel tariff in 2002, and on the first anniversary date of the tariff being enacted, the market was down 28%. He abolished the tariff shortly thereafter. So this is a for real thing. Tariff thing it's got investors spooked. And what it does, it gets all the international.
It doesn't just have investors spooked. It has sovereign leaders of other countries all ganging up on this and saying this is really going to cause a problem. But you're saying, okay, I get that part. What impact do you think that what's happening now with the tariffs, because this isn't just the steel tariff we're dealing with now, there's others that are following up. What impact do you think that is going to have on the market? Obviously a pullback, but what size of an impact?
I think that the market, because is already ripe for a significant, I'm going to say crash, okay?
9-year rally, you should have something.
Yeah. Well, I'm saying the market's already poised because by all standards that have mathematical standards, and I'm a mathematician. I'm looking at the math and I'm looking at the market historically over time and looking at ratios and all that stuff. It's way overvalued compared to anything. Okay, and it's prone right now. If you look at this table here on bull and bear markets over the last 200 years, take a look at this thing. You can see there's an even number of bulls and bears. This covers every year, this table. If you see it right there, it covers every year since 1806. And that table shows all the bulls and bears for the last 200 years, and they offset each other. Bull markets are followed by bear markets. So a bull market is when the market gets where optimism is great. Everybody's optimistic. In the Roaring '20s, everybody's optimistic. Then it's followed by a period where everybody's pessimistic. That's just the way the market works. So right. We've had one of the most optimistic periods you could possibly have. And the market's long in the tooth. So is there still a little maybe that could be squeezed out of it? Maybe, but I'm predicting that the market will go down at least 60-70% from its highs and could correct at least 50% this year. And this chart here, let's take a look at this chart here, and this is the bubbles. There's a video on the site that we have posted on the site about these bubbles. It explains how these bubbles work. Look at the bubble on the far right side here. This thing is expanding. This is a bubble that comparing the valuations of the bond market, of the stock market over the last 15 years, and you can see that every time it gets excessively overvalued, they come back together.
I was going to ask you about the integration of what's happening with the bond market, with the interest rates right now, aside from the tariffs. Do you see that as adding extra impact to this?
Oh, absolutely. The bonds, yes, the bonds are going to go up. There has to be something to close the gap in the bubble. Either the stock market goes down, or the bond market goes down. But the bond market's not
Talk about yields.
the yield. Now, if the yields, right, if the yields of the bond market, in order for this to have to go down, in order for them to meet together, if you look at the right-hand side, right, the yields have to go down for them to get together, for the bonds, and that's not going to happen, right now, because of the Fed's jacking interest rates and everything else. But there's, this bubble video has other bubbles on there too. This is not the only bubble. There's other distortions as well.
Now, not to dwell on this forever, but you also, if I recall correctly, got out and ahead of the panic and told people that they should be buying into one of the last crashes, right?
Well, yeah, I'm not a somebody who's Chicken Little, the sky's falling, the sky's falling. I'm calling it as I see it. And in 2015, in August of 2015, and here's another chart here you can look at. Here's where I called the market crashed, and you can see what it was doing for the year that year. And then I basically, 2 days later, I said, that's going to be the low for the year, and buy the market, and the market will go to new all-time highs in 2016. I said that in my Equities Magazine article. All of these things I'm telling you, by the way, including my call on Lehman, was in my Equities Magazine article. That Lehman's article, I was a columnist for Equities Magazine, and I've been for years, probably for 10 years. I'm now a columnist for WFN1 as well. My stuff's available on WFN1.
But how long will it take for the recovery, you think, once this pullback, or this, actually it'll be a bear market, once the bear market is finished? What do you think the time duration for coming back to break even is on this next leg?
I think on this one, it's a minimum of 10 years for the market to get back. Again, let's look at the chart again,
right.
The tables here. You can see here that all the bears have very, very low returns during all the bear markets. So you can't anticipate. You just have to assume this is going to take at least 10 years, probably.
Why so long this time versus the last time, 2008 or 89, and the rest of these other crashes that we've had? Why do you think it's going to take so much longer this time to make a recovery?
Well, actually, the last time, the 2000 to 2009, that was a bear market. It took 9 years. And over that period of time, so the market peaked in 2009, in 2000, and really didn't get back to its 2000 peak until 2009.
So
the market didn't do anything from it did not get back to its peak until after 2009. So they had to go back up on the upswing.
Right, but what I'm trying to get at is, are there certain factors in place now that are going to cause more devastation, that's going to take it longer to recoup and take our financial systems longer to generate a recovery, our economies to generate a recovery?
I think there is I think that we could see a depression out of this thing. It could be a 15, 20-year deal. Because if you look at the Great Depression, and that's in one of the videos, we talk about that, with all the debt that we have, the tax rates are going to go up. And after, tax rates were 26% in 1929. They went to 80%, something like 80, 60, 70, 80% within 3 years, and they went to 93% during the Eisenhower administration and stayed there for a while. Even when Reagan came in office, they were at 70%. So that chokes off the economy. So we waste so much debt. We're going to have to jack the rates up on the taxes, and the Democrats will do that once this whole thing crashes and starts. That's what's going to happen.
In order to get ahead of this, what are your studies telling you that there is an alternative investment process, an alternative investment plan where people should consider, instead of just buying and holding for the long haul and taking a beating during the duration, there's other ways to deal with this. And some people aren't into shorting the market, but they're looking for other ways to position a portfolio. You've got a strategy for that.
I think the key is, it's not return on capital. What investors should be looking for is return of capital on their investment strategy. So I advocate a 90-10 crash protection strategy. And it's similar to the black swan crash and protection strategy that is about an author that was spent 28 weeks on as a bestseller on the New York Times bestseller list. And what you do is you put your money, 80 to 90% of your money, in government bonds, and then you put the rest of your money into high risk, a diversified high risk, high reward portfolio of startups and small companies. Because what happens is in a weak economic environment or a depressed economic environment, all the new technologies are where you want to be, because it's like back in the Depression. TV was coming in, radio was coming in, all that stuff. So those people who invested in TV during the Depression made a fortune because they were investing in those new technologies. So, you know, a bear market is about distribution, and a bull market is about accumulation. So you have so many mutual funds that are going to be just, you know, selling. It just the stocks that are over-owned they're not going to get out of their own way.
How do you find out about the unicorns in that portfolio of startups? There's so many to look through. There's so many places so many websites. How do you get
what happened
get to the nugget of the gold?
The other thing that, as you know, my core expertise is also in startups. Okay, so we can provide. We have startups. People can invest. Any investor. We have different ways you can invest in startups. Put your 10% of your money to work. Private startups, and there's a lot of money being made in the digital economy in private startups. I mean, if you'd invested, you know, even $100 into Uber or Airbnb, you would have made a couple million and 1.35 million, 1.35 million on Uber and $100 over since 2009 to 2010, that period of time.
So about 4 to 8 years.
Yeah. So there's plenty of the digital economy. We have plenty of videos available about the digital economy at dynastywealth.com that people should watch, because it explains why the transformation of the digital economy from industrial, people are going to be able to make a lot of money from this, but they got to be educated about it.
Michael, thanks for being a guest on the show.
Okay.
Thanks. All right, you've been listening to Michael Yorba and Michael Markowski. He is a consistent contributor on CEO Money. You'll find his content, whether it's the bubble, it's the 90-10 investment plan, or what's coming next for our economy, on our website, WFN1.com. Thanks for joining. We'll talk to you soon.